Hello everybody, welcome to another episode of Erickson TV. This is Curtis, and Lauren's not here today. He's off working on tax returns, so I thought I would sneak out and do a solo episode. And since we're in the middle of tax filing season, one of the number one questions I receive from married couples, and even if you're not married, you might find this of interest, especially like if your parents are married or something like that, because this is about should I file jointly or do married filing separately. And so there's a couple little quirky parts of the rule. This will not be a long episode, but you might find this interesting. There's the predominant way that most people file that are married is married filing jointly. Statistics showed last year that the IRS said that 53.8 million people filed joint returns last year, while only 2.5 were married filing separately. So that's a big difference. The issue about married filing separately is that your income taxes could generally be worse because the way that the brackets are penalized for people filing separately. Now, if one spouse is higher earning and one spouse is lower earning, there's a couple of exceptions that might be worth looking at. One of the exceptions would be that if, let's say, one of the spouses that had lower earnings had a large medical deductions, that might be of value to take a look at filing separately. Another one would be if the spouses one of the spouses thinks that their other spouse is doing something that's either fabricating fake deductions or tax credits or hiding taxable income. It may make sense for the spouse to consider filing separately, just to be absolutely innocent that the IRS could ever come back and assess you back taxes. Now, if you do decide to file jointly and you don't know about, let's say, your spouse's dishonest activities, there still is what they call the innocent spouse provision, but that's a little bit harder to prove. It's so something just to be thinking about. Last but not least, and this is how I close the episode, for our clients that are in states like Washington State and California, which are called community property states, there's another issue about filing separately where unless you're considered separate property and not community property, and I'm not going to go into that, but basically you almost have to have like a prenuptial agreement or a separate property agreement, or if you inherited assets from a parent that's your own separate assets. Typically the IRS looks at community property states where they think that all income and expenses should be split 50-50. So what that means is even if one spouse is earning, let's say, $100,000 and the other spouse is earning $10,000, what they would like you to do is combine the income of $110,000, and if you choose to file separately, each report $55,000 each. So you can see in a community property state, there's generally no advantage to filing separately, and you might as well file jointly. Now, to end this episode, if you are confused and kind of going through this quickly has made it not clear to you, I wanted to let you know that when we file your tax return, I do evaluate each and every return if there's a potential benefit to file separately, so you don't have to worry about it. But I just wanted to let you know that this is a popular question and one of the number one questions that I get from married couples, and so I wanted to give you a couple of those rules. So thank you for watching this episode of Erickson TV, and we'll see you next time. Bye now.